SoFi Technologies reported earnings here today. Stock went down 10%. Now, keep in mind, SoFi stock probably would have been down no matter what today, given the way the NASDAQ was. So I wouldn't have been surprised if the SoFi was down 3 or 4 or 5% if there was no news on SoFi. So the fact that it fell 10% was not too crazy given the day we had today. Now, let me be very crystal clear about why SoFi stock fell, and then we'll get into the nitty-gritty numbers here. So SoFi stock had sank 15% on Monday after the lender issued Q1 in 2025 earnings guidance that fell short of Wall Street estimates, while Q4 EPS beat slightly when adjusting for non-recurring items. The lender and banking app company introduced 2025 guidance for GAAP, generally accepted accounting principles, earnings per share of 25 cents to 27 cents, midpoint of 26 cents, obviously, which compares to 29-cent consensus. So they missed there, right? No, there's no debate. Like that's lower than what analysts were thinking. An adjusted net revenue of $3.2 billion to $3.27 billion compared to $3.05 billion was consensus. Adjusted EBITDA is expected to rise to $845 million to $865 million from $666 million in 2024, but that's lagging what a lot of analysts are at, which is around 913, right? So the moral of the story is here, tangible book value growth is expected to be $550 million to $575 million. So the moral of the story is here in regards to this whole analyst game for SoFi, they missed a few numbers, but the numbers still look really dang good, okay? Now check this out. Let's go a little nitty gritty here on SoFi. Check this out. 10 million plus members they have now for SoFi. That's incredible. They're becoming a big dog, man. Like we're watching them grow up right in front of our eyes. We're watching these guys grow up. Look at where they were at this time last year, 7.5 million members. And now to be over 10 million members, this is an incredible accomplishment. And it looks like SoFi is on the path to, eventually being a company that has 20 million, 30 million, 50 million members of this company. You could also call them customers, right? They call them members, you could call them customers. And that's incredible. So I'm 100% convinced that SoFi is on their path to become a banking giant. A banking giant, right? And obviously a fintech giant as well. But really, I look at SoFi and I see a company that is set up to be a banking giant, just in the digital space, right? And it's just so obvious to me when you see the growth in the amount of members this company has, right? All they got to do is just make sure they make it through future recessions, get out to the other side, and then when the economy is really good, just prosper, right? Now, looking at their income statement here, I gave them a B- grade. So loans and securitizations came in at $688 million from $598 million. That's good. Other category came in at $55 million versus $46 million. That's good. Total interest income, TII, $743 million versus $645 million. That's good. Now, interest expense, securitization and warehouses, they brought down massively to $23 million from $62 million. Deposits was up as far as an interest expense there, $238 million from $182 million. Corporate borrowings was up to $12 million from $9.8 million. So total interest expense was $273 million versus $255. Now that's not bad because look at how much interest income was up. Interest income was up nearly $100 million. So to have total interest expense up less than $20 million is a huge win for SoFi. So we're looking at net interest income, which is arguably the most important line to look at when it comes to banking related companies, right? Net interest income is $470 million versus $389 million. Non-interest income, loans, origination, sales, and securitization was down for the company, a little under $10 million year over year. Servicing also was actually a negative number, $1.3 million versus $7.5 million positive. Now, as far as technology products and solutions, that was up, but not that crazy. It was only up a little over $1 million. Loan platform fees, $63 million versus only $9.3 million. So that's a night and day difference for the company, for the better. Total non-interest income, $263 million versus $225 million the same quarter last year. Total net revenue, $734 million versus $615 million. Now, their expense profile is in some categories a little out of control in my opinion. Technology product development, that's not bad. $148 million versus $141 million, not bad. Sales and marketing is definitely very aggressive for the company right now. $229 million versus $174 million, but you could also say they're attracting so many members for the long term here that it's an investment that's worthwhile for the long term. Yeah, that's very aggressive spend. We're talking about that $54 million increase year over year in sales and marketing. That's significant, but the long-term payoff should be there. Cost of operations went to $128 million versus $103 million. General administrative went to $160 million versus $131 million. Total non-interest expense went to $667 million from $552 million. So, definitely a major increase year over year. Now, income before income taxes went to $59 million from $51 million. The thing is, the numbers are just not nearly as impressive as it should be, but Anthony Noto and Sofi, they are trying to build out a company that is massive, giant for the long term, right? So I feel like sales and marketing, general administrative, cost of operation, I feel like they could have those numbers be significantly lower than where they are right now. But my belief is Anthony Noto and the team is spending so aggressively for the long-term opportunity that is here, right? Now, they had a one-off kind of income tax benefit of $272 million, so that made their net income look like it went to the moon, right? $332 million in net income versus $47 million, so it's not as good as it looks, right? If you take out that one-off. And then EPS on a diluted basis, 29 cents versus 2 cents. Also, once again, if it wasn't for that kind of one-off income tax benefit, I can tell you that EPS wouldn't even been close to that. Now, in regards to Sofi, here's the deal, okay? You can go one of two paths in regards to Sofi. You can look at this short term and be like, this number is not as strong as it should have been, and man, they're spending so aggressively on the company, so not nearly as much of that interest income is hitting that bottom line like I want to hit. But you could also take a view, glass half full here, and look at this one long term. The moral of the story is the company's fintech side of the business is growing immensely. The banking side of the business is growing incredibly strong. They're setting themselves up to be a digital banking giant, right? And so when I look at all those things and I look at Anthony Noto seems to be really building a company that is going to capitalize on this massive opportunity over its next 10, 20 years, I like what I see here. And so I'm much more glass half full here, looking at it from the long-term perspective. There will be a day when Sofi is really focused on the expense profile a lot more and not as focused on market share and stealing members. But that's not in this decade. That's not in the 2020s. The 2020s for Sofi is all about revenue growth, interest income growth, member growth, right? I feel like, 2030 beyond, 2035, 2040, that's probably going to be the days when Sofi is much more focused on the bottom line, when they're much more focused on just trying to be like a traditional bank and just making the money because they already have such huge market share there. So you really got to focus long term. I would put it like this. Sofi reminds me a lot of stocks like Palantir or even stocks like Tesla, where if Tesla comes out and reports, quarterly deliveries missed a little bit, sure, you could get all worked up over that, but at the end of the day, if you believe they're in front of several technology innovations that are massive over the next 10, 20 years, then you shouldn't be getting caught up into those short-term numbers, right? Same thing with a Palantir. Sofi reminds me a lot of Palantir. Palantir's, very volatile stock, obviously, right? Numbers move all around, but at the end of the day, when it comes to Palantir, you got to let the company does what the company does, right? And so you just got to really take a long-term approach with a stock like that, and you got to do that with a stock like Sofi. So my opinion is I would have loved for them to come out and crush all the analyst expectations. And let me be very clear. If they had come out and crushed all the analyst expectations today, the stock price would be today $20 plus. But they didn't. I think this was a quarter you walked away from feeling good about Sofi, but not feeling great about Sofi. But for a long-term opportunity like we have here with Sofi, I'm fine with feeling good. I don't need to feel great all the time, right? Hey, it's Jeremy. I hope you really enjoyed watching that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That's my advanced software that I've been working in the background creating for a long time. This software is so much more advanced than what others are presenting out there in the market. And as somebody that's been in the market 15 years, I want to create something that was simple, that had exactly everything I needed to make my judgments on companies, such as forward P ratios, 2-year
figure out forward PE ratios, price to sales ratios, forward price to sales ratios. I wanted the ability to be able to compare different companies versus each other. I wanted to be able to compare a Meta versus a Google versus an Apple and be able to see all those different metrics laid out all next to each other. I wanted a service that I could listen to conference calls right through and even be able to toggle and adjust the speed I wanted to listen to those conference calls. I wanted a service that I could search SEC filings right through. I wanted the ability to do that all in one service, and that is exactly what I've created with 1000xstocks.com. If you want to apply for access to this, go to the description area of this video. You can click that link and go ahead and apply for access to this. If you don't want to do that, you can go to 1000xstocks.com. Enjoy.
Alrighty, guys, so let's react to these articles, top 10 stocks for 2025. So here's their list of top 10 stocks, right? So Alphabet, Google McDougal. I like Google McDougal. I don't love it. I like it though. The valuation's very, very compelling on Google. Let me show you here. So take a look at this. This is on 1000xstocks.com here. What I'm showing you, very important, is Google versus Apple versus Microsoft. Three tech giants against each other. And what do you notice when you look at that? The first thing you should notice is that forward PE. That's the first thing I'm going to be looking at, right? Forward PE, I always think, is the most important metric. It's one of a billion different metrics that are important when judging a company, but I think forward PE is definitely one of the most important, if not the most important, right? So what I'm seeing here is a Google McDougal's trading at around a 22 forward PE, while Apple's around a 30 and Microsoft's around a 33, right? Which means Google McDougal is significantly undervalued as long as they can outgrow Apple and Microsoft over the coming years, right? And I mean, you look at revenue growth here over the next year, Google's at 14%. Analysts are at 8.5% for Apple. I don't think that's happening. I think Apple's not going to meet those numbers, so do keep that in mind. And Microsoft's around 15%. So we can say maybe Microsoft and Google are going to be growing around the same. So they should be somewhat more close in regards to valuation. Either Microsoft needs to come down a little or Google needs to come up some. So I like Google. I do like Google. I just don't love it. Amazon, Amazing's on, definitely love that one. Obviously, big position for me in the public account. That one should continue to perform well with their e-commerce side of their business. Then they obviously have AWS and then their advertising business, which is a big profit machine for the company. Apple, I don't like Apple. I just, no, there's just better opportunities. And that's really been the same story for Apple for the last several years. It's not that it's a bad company, At the end of the day, if my iPhone breaks, I'm going to go buy another iPhone, right? I'm so kind of stuck in the ecosystem. If I just bought a new MacBook Pro because, my wife's MacBook Air stopped working. So I gave her my old MacBook Pro and then I got a new MacBook Pro. And it's just like, that's kind of Apple's game right now. And so I have a lot of doubts about any sort of major innovation nowadays that Johnny Ive and Steve Jobs aren't at the company. Berkshire Hathaway, solid company. They're going to put up their numbers. Good company. I've owned it in the past. Meta, obviously, just a beast. Meta's very undervalued. Very undervalued. That stock's, in my opinion, based upon where I did my projections at recently, the stock's going to $1,000 plus. In very short amount of time. That's the thing you got to understand. Like, it's not like, Meta's going to be $1,000 someday, like 10 years from now. No. It's going to be there rather quickly. When you run your projections on Meta, which I have been doing work on the projections because we're trying to add an advanced projections right now in 1000X, which is going to be sick, where you're going to be able to take into account share count, dilution, or addition. Like, it's going to be so sick. So I've been working on upgrading the projections feature right now, actually. But as far as Meta goes, like, you run your numbers, oh my gosh, like steal deal. The stock will be $1,000 plus likely in the next 24 months. And then we're heading to $2,000 before this decade is at a close. Mr. Sofi, solid company. I don't love it here. I think it's okay. But, they're going to put up their numbers. NVIDIA, I think that's fine as well. I don't think it's, when it comes to NVIDIA, here's the thing, okay? I think they're set up really well for the next few years to either hold what they have now for gains or to, continue to grow the stock price. The thing that you should not expect from NVIDIA is those sorts of outsized gains over this next few years. If you're thinking the stock's going to triple up, quadruple up, 10x, like, not likely happening. They've pushed the numbers up so far, the margins up so far, the profitability up so far that even growing past 2025 is going to be really, really difficult in terms of getting big raises in revenue and profitability. So that's kind of the deal with NVIDIA, but they're fine though. Occidental Petroleum, I'm just not the biggest fan of any of the oil and gas stocks. I don't own any of them. They don't interest me. Uber, Uber looks okay valuation-wise. It's just their big overhang is going to be Tesla, right? And Waymo that Google owns. That's going to be the big overhang there. So to get Uber stock up in any substantial way, it's going to be really, really difficult. And then just kind of VU, S&P 500, which is always understandable. Now, this is from kind of more of a quant angle on their top stocks for 2025. So first one up here is they have this company named OppFi. OPFI. It's a pretty small company, actually, a $650 million market cap. Quant ratings are strong buy. They're in the financial sector. Powered by AI-driven underwriting, OppFi leverages its scalable tech platform to provide credit access to underserved middle-income consumers, so the middle class basically. The company delivered exceptional Q3 2024 earnings results with revenue reaching a new high of $136 million. At the same time, generally accepted accounting principles, net income more than doubled year over year, driven by improved credit performance, higher yields, and better operational efficiency. The company boasts select profitability metrics with a 100% gross profit margin and 32% return on equity, which are substantially higher than the sector median. Okay. Valuation is a standout given the stock's incredible 90% price return in the last 3 months. Oh my gosh. The company is currently trading at more than a 25% reduction in terms of its forward PE, while its trailing 12-month price to earnings growth, that's PEG there, price to earnings growth, gap multiple is more than 95% discounted relative to the financial sector. Wow. OppFi has positioned itself with a broader digital financial services platform, evidenced by its investment in small business lender Biddy. With solid performance in business positive timeless indicators like EPS revisions and price momentum, OppFi is a small cap poised for further upside potential should the sector experience a substantial rally. Seems interesting. I would like to do a little digging there. PayPal. I think I'm going to like this one a little bit. Obviously, major position for me in the public account, right? Strong buy they have. PayPal is a leading fintech company and provides global digital payment solutions for the financial services sector. With more than 400 million active accounts and enormous reach, PayPal offers a comprehensive suite of products to complement its flagship peer-to-peer transfer capabilities. The company is driving growth through multiple initiatives, including the new fast lane checkout solution and its strategic partnerships with major players like Shopify. These efforts, and by the way, Shopify is a nice sized position I have in the Patreon portfolio. These efforts have contributed to a forward revenue growth that is 25% greater than the broader financial sector. PayPal sports an A profitability grade supported by its incredible $7.67 billion in cash from operations and the return on equity ROE of 22%. Which is over 100% above the sector median. Solid growth, exceptional profitability, and price momentum have led to an outstanding 38 FY1 up revisions in the last 90 days. So yeah, basically analysts are getting more bullish on it with 0 downward revisions, demonstrating Wall Street's consensus optimism around the stock. While the company's recent performance has detracted from its valuation profile to some degree, PayPal is trading at a sector relative discount in terms of price to sales and price to cash flow ratios. Despite increased competition, PayPal's brand recognition, robust financial position, and a focus on innovation make it well positioned for future growth, increasingly popular digital payments landscape. Yeah, and the thing with PayPal is they've made a lot of strategic moves recently to kind of focus on profitability, which hurts revenue in the short term, but don't be surprised if revenue shows quite some accelerations in 2026 and 2027. Now, they also have this one, Brinker International, which is in the restaurant sector. I don't like this one. They own Chili's and some other brands. I don't like it. I don't like it at all. Nope. Cake's got it over them all day, every day. Stride, $4.56 billion consumer discretionary company. They have a strong buy education services. Stride is a technology-based education company providing innovative online and blended learning solutions, K through 12, career learners, and adult education. The company offers a comprehensive suite of products and services, including a proprietary and third-party curriculum. That's interesting. Companies focused on meeting demand for flexible, customer-focused virtual learning solutions, specifically enhanced at career-forward skills. In the first quarter, fiscal year 2025, the company saw an 18.5% increase in enrollment, totaling 222,000. Only thing that would make it better if it was 222,222. With revenue that increased 15% and adjusted operating income that increased 295%. You gotta be flipping my flapjacks. That's impressive. Company's tremendous growth has translated into solid profitability. LRN boasts a trailing 12-month EBITDA margin of 16%, which is a staggering 40% above the sector median and offers an incredible $7.41 in cash per share. Dang, they're loaded with cash. They're loaded with cash, these guys. Interesting. That one may be worth taking a look at. Urban Outfitters, not interested. Nope. None of those traditional kind of retailers like that. No, thank you. Argan, industrials, construction, engineering. That's not going to interest me either. Not that, I'm sure it's a fine company. It's just nothing in that space is interesting to me. DXP Enterprises, also in the industrials, trading companies and distributors. Also not going to be one that is interesting to me. So this company, Celestica, Information Technology, $11 billion market cap. This company's emerged as a standout in electronics manufacturing services stock. The company's success has been driven by its strategic pivot to AI infrastructure manufacturing, particularly through its focus on network switches for data centers. The company's connectivity and cloud solutions segment represented 67% of total revenues. So another company that I'm sure is not a bad company. It's just, I think there's better ways to play that space. Next one in here, IntApp, strong buy application software. At the forefront of modernizing critical operations, IntApp provides cloud-based software solutions designed to manage client relationships, deal flow, compliance requirements for professional services firms. The company's net income doubled to $15.1 million, which sounds great. Oh, they doubled their net income, but the market cap's $4.85 billion. So keep that in mind. It's basically like nothing. Driven by enterprise client expansion, new AI products contributing to the company's B profitability grade. This company displays other strong fundamentals, in particular an A+ growth grade supported by a forward revenue growth of about 17% versus the sector around 5%. And year-over-year operating cash flow growth of 123%. Okay, yeah, this one might be interesting. Might be. If they can keep doubling doubling net income year after year after year for a time, then they'll be doing some big numbers, right? And last one up here of these is Credo Technologies Group Holding, Information Technology. This one's a $12 billion market cap, almost $13 billion market cap. In 2024, niche suppliers of services of AI infrastructure demands experienced extraordinary success. In 2025, is likely to be a continuation. Founded in 2008, Credo Technologies is a number 2 quant ranked semiconductor stock and the number 3 quant ranked overall technology company. The company specializes in developing innovative products optimized for Ethernet applications, including integrated circuits and active electrical cables. Credo has a great growth. The company is driven by strong demand for AI data centers. Key highlights include forward EBITDA growth of 129%. Yeah, that's pretty impressive versus 5% for the sector. And EPS forward long-term growth exceeding the sector median by 500%. So this one might be interesting to take a little dive into as well. So of these, I would say this one, Credo, would be interesting to take a peek at. Maybe this IntApp as well, although, that one's got a long way to go with profitability. I don't know, maybe this company, this Celestica. DXP doesn't interest me. Argan doesn't interest me. Urban Outfitters doesn't interest me. The Stride company, This Stride company actually looks somewhat interesting. That one would be worth taking a peek at, I think. Brinker International does not interest me. I don't want to own freaking Chili's. Give me a break. PayPal, obviously, interests me. And then this company, this OppFi, might be something there. So those are kind of the ones that at least are somewhat interesting to me.